Before we begin, it's essential to state that I am not a financial advisor, and this video is for educational and informational purposes only. The content presented here is not financial, legal, or tax advice. Investing in the stock market, especially in sector-specific funds, involves significant risk, including the potential loss of principal. You should always conduct your own thorough research and consult with a licensed financial professional before making any investment decisions. Your financial situation is unique, and any action you take based on this presentation is solely at your own risk. You feel it every single week. You pull up to the gas pump, you slide your card, and you watch those numbers spin faster and faster, almost mockingly. A knot forms in your stomach as you realize that what used to be a $40 fill-up is now $60, $70, or even more. Then you get home and there it is on the counter, the electricity bill, the gas bill, and they're higher. Again, it feels like you're being squeezed from all sides by the rising cost of energy. It's a constant, frustrating drain on your wallet, a tax on just existing. But what if I told you there's a way to flip the script? What if, instead of just paying for energy, you could get paid by energy? What if every time you saw a headline about rising oil prices, instead of feeling dread, you felt a flicker of excitement? What if you could turn one of your biggest household expenses into one of your most powerful investment opportunities? This isn't some Wall Street fantasy reserved for oil barons and hedge fund billionaires. This is a strategy available to everyday American investors, and the vehicle to do it is something called an energy mutual fund. And by the end of this presentation, you are going to understand exactly how they work. We're not just going to skim the surface. We are going deep. You will learn what these funds actually are, how they make money, the different types of energy companies they invest in, and most importantly, how to start thinking about whether they might fit into your own financial plan. We're going to demystify the jargon, cut through the noise, and give you the foundational knowledge you need to look at the energy sector not as a source of pain, but as a source of potential. Because let's be honest, the world runs on energy. It is the literal lifeblood of our economy. It powers our homes, our cars, our phones, the factories that make our goods, and the servers that host this very video. It's an undeniable, non-negotiable part of modern life. And because of that, the companies that find, produce, and transport that energy hold an immense amount of economic power. For decades, the only way for the average person to tap into that power was to try and pick individual winning stocks. A risky and often losing game. You'd have to be an expert geologist, a commodities trader, and a geopolitical analyst all rolled into one. But a mutual fund changes the entire game. It allows you to invest in the entire trend of energy, without having to bet the farm on a single company striking oil in West Texas. It's about owning a piece of the whole system. So let's start with the absolute basics. When we say the energy sector, what are we even talking about? It sounds like this big, vague concept, but it's actually a highly structured industry with three main parts. Think of it like the journey of a single drop of oil. First, you have what's called upstream. These are the explorers, the drillers, the wildcatters. These are the companies that are out there searching for and extracting raw materials from the ground. They're the ones with the massive offshore rigs and the sprawling oil fields. Companies like ExxonMobil, Chevron, or ConocoPhillips are huge players in the upstream space. They are on the front lines, and their profits are often directly tied to the real-time price of oil and natural gas. When commodity prices are high, these companies can be incredibly profitable. When prices crash, they feel the pain first and hardest. Investing in upstream is a direct bet on the price of energy itself. It's high risk, but it can also be incredibly high reward. Next, once that oil or gas is pulled from the ground, it needs to get to a refinery to be processed. This is where the midstream companies come in. Think of them as the toll road operators of the energy world. They own and operate the infrastructure, the pipelines, the storage tanks, the shipping terminals, the railways. They don't drill for oil and they don't sell you gasoline. They simply get paid to move and store the product from point A to point B. Their business model is often fee-based, like collecting rent. This makes them less sensitive to the wild swings in commodity prices. Whether oil is at $50 a barrel or $150, they are still getting paid their fee to transport it. This can make them a more stable, often dividend-paying part of the energy ecosystem. They are the crucial link, the arteries and veins of the entire industry. Finally, you have downstream. This is the part of the journey you interact with every day. These are the companies that take the raw crude oil and natural gas, refine it, and turn it into the finished products we all use. Gasoline for our cars, jet fuel for airplanes, heating oil for our homes, and the chemical components for plastics and fertilizers. Your local gas station, whether it's a Shell or a Marathon, is the final stop in the downstream process. These companies make their money on the crack spread, the price difference between what they pay for a barrel of crude oil and what they can sell the refined products for. Their profitability is tied to consumer demand and their own operational efficiency. Upstream, midstream, and downstream. The explorers, the transporters, and the refiners. Every energy mutual fund is built by investing in some combination of these three categories. Some funds might focus heavily on the high-risk, high-reward upstream drillers. Others might prefer the steady, dividend-paying midstream pipeline companies. And many will hold a diversified mix of all three. Now, what about the mutual fund part of the equation? This is where it gets brilliant for the individual investor. A mutual fund is simply a company that pools money from thousands of investors, people like you and me, and uses that money to buy a diversified portfolio of stocks, bonds, or other assets. In our case, an energy mutual fund pools our money and a team of professional fund managers uses it to buy dozens, or even hundreds of different energy stocks. Instead of you having to research hundreds of companies, analyze geological surveys, and track global supply chains, a team of full-time experts does it for you. You're not buying a single stock, you're buying a basket of them. It's like instead of trying to pick the one player who will be the MVP this season, you get to bet on the success of an entire all-star team. If one company in the fund has a bad quarter or a drilling project that fails, it's cushioned by the success of the dozens of other companies in the portfolio. This is the power of diversification, and it's the core principle that makes mutual funds such a popular and powerful tool for building long-term wealth. So when you combine these two concepts, an energy mutual fund is a professionally managed portfolio that gives you instant, diversified exposure to the entire energy industry, the upstream explorers, the midstream transporters, and the downstream refiners. With a single purchase, you can own a slice of the companies that power our entire nation. You are no longer just a consumer of energy. You become an owner. This is the fundamental shift in mindset. It's about moving from the person paying at the pump to the person who, in a small but meaningful way, owns a piece of the pump itself. This is the starting point. This is the foundation upon which a powerful investment strategy can be built. But knowing what these funds are is only the first step. The real question is, how do you find a good one? And how do you know if now is even the right time to invest? The forces shaping the energy market today are more complex than ever before, creating both massive risks and once-in-a-generation opportunities. To understand these forces, you first have to understand the sheer, mind-bending scale of the energy sector. This isn't like investing in a new software company or a popular retail brand. Energy is the circulatory system of the entire global economy. It's the fuel in the truck that delivers your packages, the power that lights up your screen, and the foundation of basically every single product you touch. And because it's so fundamental, it's influenced by everything. A political shift in the Middle East, a technological breakthrough in a lab in California, a hurricane in the Gulf of Mexico, a new regulation passed in Washington, D.C. All of these can send shockwaves through the market in an instant. For an individual investor, trying to track all of this is like trying to captain a supertanker in a perfect storm with nothing but a rowboat paddle. You can pick a single company, say a big-name oil giant. But what if they have a catastrophic oil spill? Or what if their big bet on a new oil field in South America comes up dry? Your entire investment could be crippled overnight. On the other hand, you could bet on a promising new solar panel manufacturer. But what if a competitor develops a more efficient technology? Or what if changes in government subsidies suddenly make their business model unprofitable? Again, you're exposed. You're carrying all the risk of that one single decision. This is the core problem that energy mutual funds were designed to solve. They are the supertanker, not the rowboat. The fundamental idea is simple, but its execution is incredibly powerful. An energy mutual fund is a giant pool of money, collected from thousands, sometimes millions of individual investors like you. Instead of you investing your $5,000 alone, your money is combined with $1 billion from everyone else. This massive war chest is then handed over to a team of professional fund managers. And this is their entire world. These managers aren't just casual stock watchers. They are often industry veterans, geologists, engineers, and economists who live and breathe the energy market. Their job is to take that billion-dollar pool of capital and strategically invest it across a wide spectrum of energy companies. They're the ones analyzing drilling reports, forecasting global demand, and assessing the political stability of oil-producing nations. They're the ones who have the resources to visit a new lithium mine or get a private briefing on a next-generation nuclear reactor. They are, in essence, a highly specialized full-time research department that you, the individual investor, get to hire for a very small fee. So, how do they actually do it? This is where it gets fascinating because not all energy funds are built the same. They each have a specific strategy, a unique flight plan, that dictates where they invest. This plan is outlined in a document called a prospectus, which we'll tear apart later, but for now, let's understand the main approaches. The first way they differentiate is by focusing on different parts of the energy supply chain. In the traditional oil and gas world, this is broken into three main categories. First, you have upstream companies. These are the explorers, the wildcatters, the ones who find and extract the raw materials from the ground. Think of them as the treasure hunters. It's a high-risk, high-reward business. A successful new oil field can mean astronomical profits, but a series of dry wells can be devastating. Next, you have midstream companies. These are the movers. They own and operate the vast network of pipelines, storage facilities, and supertankers that transport oil and natural gas from the wells to the refineries. Think of them as the toll road operators of the energy world. Their business is often less volatile because they get paid for the volume of product they move, regardless of whether the price of oil is $50 a barrel or $150. Finally, you have downstream companies. These are the refiners and marketers. They take the crude oil and turn it into the products we use every day: gasoline, diesel, jet fuel, and plastics. They also include the gas stations on the corner. Their profits are often tied to the crack spread, which is the difference between the price of crude oil and the price of the refined products they sell. An energy mutual fund manager has to decide on their mix. Do they want a fund that's heavy on the high-risk, high-reward upstream explorers? Or do they want a more stable, income-focused fund filled with midstream pipeline companies that pay consistent dividends? Or do they want a balanced approach that holds a bit of everything? The fund strategy will tell you exactly what kind of exposure you're getting. But today, that's only half the story. The biggest shift in a century is happening right now: the energy transition. This creates a whole new axis for a fund manager's strategy. A fund might be a traditional energy fund, focusing exclusively on the oil, gas, and coal companies that power the world today. Or it could be a clean energy or renewable energy fund. These funds avoid fossil fuels entirely and instead invest in companies leading the green revolution: solar panel manufacturers, wind turbine giants, electric vehicle battery makers, and hydrogen fuel cell innovators. And then you have the energy transition, or all of the above funds. These managers believe the shift to renewables will take decades, and that the best strategy is to invest in both sides. They might hold shares in a massive oil company that is using its profits to invest heavily in carbon capture technology and wind farms, alongside a pure-play solar company that is rapidly expanding its market share. This is an active bet on the entire evolution of the sector. On top of all this, the fund manager also applies classic investment philosophies. Is it a growth fund, seeking out smaller, innovative companies that they believe could be the next industry titans, even if they aren't profitable yet? Or is it a value fund, looking for large, established, and perhaps undervalued companies that are generating steady cash flow and paying dividends to their shareholders? So what does this all mean for you? It means when you invest in a single energy mutual fund, you're not just buying one stock. You are instantly buying a piece of dozens, sometimes hundreds of different companies, all carefully selected by a professional team to fit a very specific strategy. This is the power of diversification. If one company in the fund goes bankrupt, it's a small dent, not a catastrophe for your investment. If one subsector, like offshore drilling, has a terrible year, it can be offset by gains in another area, like natural gas pipelines. The fund structure is designed to absorb shocks and smooth out the ride. You are outsourcing the impossibly complex 24/7 job of monitoring the global energy market. You no longer have to worry about the latest OPEC meeting or the technical specifications of a new battery chemistry. You're leveraging the expertise of people who do this for a living, and you're gaining access to a portfolio that is intentionally built to navigate the massive risks and seize the once-in-a-generation opportunities we talked about. So you have this powerful vehicle, a professionally managed portfolio with a clear flight plan. But that leads to the most important questions of all. How do you look under the hood? How do you know if the managers are any good? And how can you tell if their strategy actually makes sense for you and your money? The answers to all of these questions are hiding in plain sight, in a legal document that 99% of investors either throw away or never read. It's called the fund's prospectus. And in the next part, we are going to show you how to read it, how to decipher its code, and how to use it to separate the winners from the losers. Hey, let's be honest. Nobody gets excited about reading a prospectus. It's a dense black and white document, written by lawyers, and it looks about as thrilling as a tax form. Feels like homework. And that's exactly why it's your single greatest advantage. Because while everyone else is tossing it in the trash, you're about to learn how to read the secret language hidden within its pages. This isn't just a legal document, it's a treasure map. It's the game's instruction manual that tells you all the cheat codes. The people who make serious money in mutual funds, they read this. So let's crack it open. The first thing you'll likely receive is something called a summary prospectus. Think of this as the Cliff's Notes version. The full, statutory prospectus can be 100 pages long, but the summary boils it down to the essentials, usually just a few pages. This is our target. This is where the gold is buried in plain sight. The very first section you'll see is arguably the most important. It usually has a title like Investment Objective, Strategies, and Risks. This is the fund's entire personality on one page. It's the what, how, and what if. Let's start with the what. The investment objective. This is the fund's mission statement. It's a single sentence that tells you what the fund is trying to accomplish. Is it seeking long-term capital appreciation? That's code for, we're trying to grow your money over time. Is it seeking current income? That means we're trying to generate regular cash payments like dividends. For an energy fund, this is crucial. An objective of capital appreciation might mean the fund is investing in risky, small-cap oil exploration companies, betting on one of them striking the next mother lode. An objective of income probably means it's focused on stable, dividend-paying giants like pipeline operators or major integrated oil companies like Chevron. Right away, you know if this fund's mission aligns with your own. Are you looking for a lottery ticket or a reliable dividend check? The objective tells you. Next comes the how, the principal investment strategies. This is the playbook. This section details how the fund manager plans to achieve that objective. This is where you get to look over the manager's shoulder. It will say things like, under normal circumstances, the fund invests at least 80% of its assets in securities of companies in the energy sector. Okay, that's the basics. But dig deeper. Does it specify what kind of energy companies? Does it say integrated oil and gas, exploration and production, oilfield services, or midstream? These aren't just fancy words. They represent completely different parts of the energy world with different risk profiles. Is the fund allowed to invest in foreign companies? Can it use complex derivatives like options or futures? This section tells you exactly what tools the manager is allowed to use. It's the difference between a chef who only uses a frying pan and one who has a full Michelin star kitchen. You need to know what you're paying for. And then comes the what if, the principal risks. This is the part everyone skips because it's scary. It's a long list of all the things that could go wrong. Don't skip it. Read it. Understand it. This isn't about scaring you away. It's about preparing you for the reality of the market. For energy funds, you'll see specific risks you won't find in a tech fund. You'll see commodity price risk. This is the big one. It means the fund's value is heavily tied to the price of oil and natural gas. If oil prices crash, this fund will get hurt. Period. It tells you that you're not just investing in a company. You're making a bet on the global price of a commodity. You'll also see regulatory risk. A new law out of Washington, like a carbon tax or a ban on fracking, could kneecap the companies in your fund overnight. You'll see geopolitical risk. A conflict in the Middle East, a political shift in a major oil-producing nation. These things can send shockwaves through the energy market. Knowing these risks doesn't mean you should run for the hills. It means you understand the battlefield. You know what to watch for in the news. You're no longer a passive passenger. You're an informed investor. Now for the part that can make or break your entire investment journey. Fees and expenses. If the investment strategy is the fund's engine, the fees are the constant, invisible friction that slows it down. This section is non-negotiable reading. It's presented in a standardized table, making it easy to compare funds, and it's where you can save yourself thousands, even tens of thousands of dollars over your lifetime. The most important number in this entire document is the total annual fund operating expenses, more commonly known as the expense ratio. Think of it this way. The expense ratio is a small guaranteed leak in your investment bucket. Every single year, A certain percentage of your money leaks out to pay for the fund manager's salary, marketing, and administrative costs. It happens whether the fund makes you money or loses you money. Let's say a fund has an expense ratio of 1.25%. That doesn't sound like much, but it means that for every $10,000 you have invested, you are paying them $125 every single year. Now imagine another fund that does almost the exact same thing but has an expense ratio of 0.5%. That's $50 a year. The difference, $75, might seem like a pizza dinner, but compound that over 20 or 30 years. That difference becomes a car. It becomes a down payment on a house. It is the single biggest predictor of future returns. Lower fees almost always lead to better long-term results. But wait, there's more. The fee table also shows you shareholder fees. These are transaction costs. You might see a front-end load. This is a sales charge you pay just to get into the fund. A 5% front-end load means if you invest $10,000, only $9,500 actually goes to work for you. The other $500 goes straight to the broker. There are also back-end loads you pay when you sell. My advice? In today's market, with so many incredible options available, you should almost never pay a sales load. Look for no-load funds. Next, you'll find the performance section. This is the fund's report card. It will show you a bar chart of the fund's annual returns for the past 10 years. It's tempting to look at this and get excited by a year with a 40% gain. But the pros know better. In a volatile sector like energy, one good year means nothing. What you need to look for is consistency. More importantly, how did the fund perform during the bad years? Look at 2014 when oil prices collapsed. Look at 2020. Did the fund lose less than its competitors? That shows skill. Anyone can look like a genius in a bull market. A great manager proves their worth in a crisis. Right below that chart is the most critical comparison. It's a table that shows the fund's performance against a relevant benchmark, like the S&P 500 Energy Index. This is the moment of truth. The benchmark is basically the average performance of the entire energy sector. You are paying your fund manager through that expense ratio to be smarter than average. You're paying them to beat the benchmark. If this fund has consistently underperformed its benchmark over 3, 5, and 10 years, you have to ask yourself a very serious question. What exactly am I paying for? If the manager can't even keep up with a simple cheap index, you are lighting your money on fire. Finally, there's a small but vital section on management. This tells you who is actually making the investment decisions. It lists the portfolio manager or managers and, most importantly, their tenure, how long they've been running this specific fund. Why does this matter? Because a fund's brilliant 10-year track record is meaningless if the manager responsible for it left last year. If the star quarterback who won 3 Super Bowls just retired, you can't expect the rookie replacement to put up the same numbers. If the manager's tenure is short, say 1 or 2 years, then that long-term performance history is largely irrelevant. You're investing in the manager's skill, so you need to make sure the person whose record you're admiring is still the one calling the shots. So, this boring document, this prospectus, is actually an intelligence dossier. It tells you the mission, the playbook, the hidden costs, the historical performance against its peers, and who's flying the plane. By spending just 15 minutes deciphering this code, you elevate yourself from the 99% of investors who are flying blind and join the 1% who make informed, intelligent, and profitable decisions. You've now learned how to analyze a single fund, but the world of energy investing isn't monolithic. It's a spectrum, from the safest, most stable pipeline companies to the wildest of wildcat drillers, and even into the explosive world of clean energy. The funds that invest in them are just as diverse. So let's peel back the layers. Think of the energy sector not as one giant company, but as a massive, sprawling city. In this city, you have different neighborhoods, each with its own character, its own risks, and its own rewards. The mutual funds are the tour buses, and you need to decide which neighborhood you want to explore. First, you have the oldest, most established neighborhood, downtown oil and gas. This is where the skyscrapers are, the names you know, ExxonMobil, Chevron, ConocoPhillips. Funds that focus here are the traditionalists. They believe in the enduring power of fossil fuels. But even this downtown district is split into 3 distinct zones, and understanding them is the absolute key to not getting lost. The first zone is upstream. This is the most exciting and the most dangerous part of the city. These are the exploration and production companies, the wildcatters, the modern-day prospectors. They're the ones drilling holes in the ground in West Texas or deep under the Gulf of Mexico, betting billions of dollars that they'll strike black gold. An upstream-focused fund is a direct bet on the price of oil and gas. When crude oil prices shoot up, these companies can print money, and the fund's value can skyrocket. It's a pure high-octane play. But when prices collapse, it's brutal. These companies can see their profits evaporate overnight. Investing in a pure upstream fund is like riding a bucking bronco. It's a thrilling ride to the top, but you can get thrown off in a heartbeat. It's for investors with a strong stomach and a firm belief about where commodity prices are headed. Now let's move to the second zone, the one that connects everything midstream. If upstream is the wild frontier, midstream is the infrastructure that tames it. We're talking about the pipelines, the storage tanks, the shipping terminals, and the tankers. These companies are the toll road operators of the energy world. They don't care as much if oil is $100 a barrel or $50. They get paid to move it from point A to point B. Their contracts are often long-term and fee-based. This makes midstream companies far more stable and predictable than their upstream cousins. A midstream-focused fund is typically for the income-oriented investor. They throw off a lot of cash, often in the form of juicy dividends. You'll often hear the term MLP, or Master Limited Partnership, associated with these. It's a special business structure many pipeline companies use for tax reasons. We don't need to get bogged down in the tax law weeds, but what you need to know is that funds specializing in midstream are built for cash flow. They're the landlords of the energy city, collecting rent month after month. The returns might not be as explosive as upstream, but the ride is a whole lot smoother. Finally, we have the third zone, downstream. This is where the raw product gets turned into something you and I actually use. These are the refiners and the marketers, the companies that take crude oil and crack it into gasoline, diesel, jet fuel, and plastics. Think Valero or Marathon Petroleum. A downstream-focused fund is a different beast entirely. Its success isn't just tied to the price of oil. It's tied to the difference between the price of oil and the price of the refined products they sell. This is called the crack spread. When this spread is wide, meaning they can buy crude cheap and sell gasoline for a high price, they make a fortune. But it's a complex, margin-driven business. They have to worry about refinery maintenance, seasonal demand for gasoline, and global economic activity. These funds can do very well when the economy is humming along, but they can get squeezed when their margins shrink. So you have the wildcatters, the toll collectors, and the manufacturers. Most investors, however, don't just pick one zone. They get on the big red tour bus, the broad-based energy fund. This is the most common type of energy mutual fund you'll find. It's the S&P 500 of the energy world. These funds are like a combo meal. They give you a little bit of everything. They'll own the big integrated supermajors like Exxon, which operate across all three zones. They'll own some pure-play upstream drillers for that explosive growth potential. They'll own a few midstream pipeline companies for stability and income. And they'll own some downstream refiners to capture consumer demand. The advantage here is diversification within the sector. If oil prices fall, hurting their upstream holdings, perhaps the lower input costs will help their downstream refining stocks. It's a way to get exposure to the entire energy value chain without making a specific bet on one part of it. For many people, this is the default, the set-it-and-forget-it way to invest in energy. But make no mistake, even though it's diversified across the zones, it's still a bus touring the same city. Its fate is overwhelmingly tied to the health and profitability of the traditional oil and gas industry. But what if you want to visit a completely different city? A newer, shinier city being built right next door? That brings us to the clean and renewable energy funds. This isn't just a different neighborhood. It's a parallel universe of investing. These funds aren't buying oil drillers. They're buying the architects of our energy future. They invest in solar panel manufacturers, wind turbine giants, electric vehicle charging networks, battery storage innovators, and green hydrogen pioneers. The entire investment thesis is different. You're not betting on the price of a barrel of oil. You're betting on the pace of technological adoption. You're betting on government policy, on subsidies and tax credits like those in the Inflation Reduction Act. You're betting on a long-term secular shift away from carbon. The risk profile is completely different, too. These companies often act more like tech stocks than industrial stocks. They can be incredibly volatile, driven by sentiment, interest rates, and competitive breakthroughs. A single new battery chemistry from a rival could send a company's stock plummeting. A new government mandate could send it to the moon. These funds offer the potential for massive, world-changing growth, but they are not for the faint of heart. It's a high-growth, high-risk world, much like the tech sector in its early days. And between these two cities, the old world of fossil fuels and the new world of renewables, lies a fascinating and growing category: the energy transition funds. These are the hybrids, the bridge builders. They operate on a more nuanced philosophy. They recognize that the shift to green energy won't happen overnight. So what do? They invest in the transition itself. A fund like this might invest in a traditional oil company, but only if that company is spending billions to build out carbon capture technology or become a leader in biofuels. They might invest heavily in natural gas companies, viewing it as a cleaner bridge fuel to phase out coal while renewables scale up. They might invest in utility companies that are aggressively shutting down old power plants and building out massive solar and wind farms. These funds are for investors who see the shades of gray. They believe in the eventual green future, but they also understand the economic and physical realities of the present. They want to profit from the decades-long journey, not just bet on the final destination. It's a sophisticated strategy that tries to capture the best of both worlds, investing in the incumbents who are adapting and the challengers who are innovating. So we have the pure-play specialists, the broad-based traditionalists, the high-growth futurists, and the pragmatic transitionists. Each one offers a completely different lens through which to view the energy market and a different engine to power your portfolio. The question is no longer just, should I invest in energy? The real question is, what kind of energy future am I investing in? But choosing a category is only the first step, because within each of these categories there are dozens, even hundreds of funds, and they are not all created equal. How do you tell a well-managed high-performance machine from a clunker that's full of hidden fees and bad bets? It all comes down to looking under the hood and learning how to read the manual. And that manual has a name: the fund prospectus. So let's crack open this manual. The fund prospectus. I know. Just saying the word prospectus is enough to make most people's eyes glaze over. It looks like it was written by lawyers for lawyers and designed to be as dense and unreadable as possible. It's long, it's full of fine print, and it feels like a legal trap waiting to be sprung. But here's the secret. You don't have to read every single word. You just need to know where to find the gold. Think of it less like a novel and more like a treasure map. You're looking for a few key coordinates that will tell you everything you need to know about whether this fund is a treasure chest or a booby trap. The very first place you look on this map is for the fund's investment objective. This is the big, bold headline. It's the fund's mission statement. It's the manager telling you, in plainish English, what they are trying to accomplish with your money. Is this fund trying to be a slow and steady dividend-producing machine, investing in massive, stable utility companies that are the bedrock of the energy grid? Or is it a high-octane thrill ride, chasing explosive growth by investing in speculative shale oil startups or in proven green energy tech? The objective tells you the destination. It's crucial. If you're looking for a safe, reliable family minivan to get you to retirement, you don't want to accidentally buy a Formula One race car that could either win the championship or crash and burn on the first lap. The objective is your first filter. If it doesn't align with your personal financial goals, you can close the map and move on to the next one. No harm, no foul. Okay, so you found a fund whose objective matches your own. You want that race car. You're looking for aggressive growth in the renewable energy space. Great. The next section you hunt for is principal investment strategies. If the objective was the destination, the strategy is the route the fund manager plans to take to get there. This is where the rubber meets the road. It's the manager's game plan. They have to tell you how they're going to achieve that objective. Will they primarily invest in large, established solar and wind companies? Or will they focus on smaller, more nimble companies developing next-generation battery technology? Will they only invest in U.S. companies? Or will they go global? Do they have the flexibility to invest in bonds, or use complex financial instruments like options and futures to hedge their bets or juice their returns? This section is a window into the fund manager's mind. It reveals their philosophy. Some funds might have a very strict strategy, like only investing in companies with a market capitalization over $10 billion. Others might be more flexible, giving the manager the freedom to pivot as the market changes. There's no single right answer, but you need to understand the playbook. This is the promise the fund is making to you. It's them saying, here's how we're going to try to make you money. And it's your job to decide if that plan sounds brilliant or half-baked. Now for the part everyone skips but no one should. The principal risks section. This is the part of the treasure map marked with skulls and crossbones. It's the here be dragons territory. Every single investment on planet Earth carries risk, and mutual funds are no exception. By law, the fund has to disclose all the major things that could go wrong and cause you to lose money. And in the energy sector, this list can be long and scary. You'll see things like commodity price risk. This is a big one. It means that if the price of oil, natural gas, or lithium suddenly plummets, the stocks in the fund are going to get hammered. You'll see geopolitical risk. An unexpected war in the Middle East or a political shift in a major oil-producing nation can send shockwaves through the entire sector. You'll see regulatory risk. What if a new government passes sweeping environmental laws that make it more expensive for oil companies to operate? Or, on the flip side, what if they slash solar subsidies, hurting renewable energy stocks? The fund has to tell you about these dangers. It's their confession. They are legally obligated to lay out the worst-case scenarios. Reading this section isn't meant to scare you out of investing. It's meant to educate you. It's the difference between flying blind in a storm and flying with a full instrument panel, fully aware of the turbulence ahead. Understanding the risks helps you understand why the fund might be down 15% one year and up 30% the next. It's the character of the investment. Alright, we've covered the destination, the route, and the dangers. Now for the most important number in the entire document, the one that can silently sabotage your entire financial future if you ignore it. The fees, specifically, the expense ratio. Imagine you and your friend both start a road trip. You both have the same car, the same destination, and you both drive perfectly. The only difference is that every 100 miles, your car automatically siphons a gallon of gas out of your tank, while your friend's car only siphons out a quart. First, you barely notice the difference. But over a trip that's thousands of miles long, you're going to end up far, far behind. You might even run out of gas before you reach the destination. That is exactly what the expense ratio does to your investment. The expense ratio is an annual fee, expressed as a percentage of your investment. It covers the fund's operating costs, things like the fund manager's salary, marketing, and administrative expenses. It's automatically deducted from the fund's assets, so you never see a bill. It's a silent, invisible drag on your performance. And the differences can be staggering. Let's say you invest $10,000. Fund A has an expense ratio of 0.5%. Fund B, which invests in almost the exact same things, has an expense ratio of 1.5%. You might think, what's 1%? It's nothing. But let's see the magic of compounding work in reverse. Over 30 years, assuming an average 8% annual return before fees, your $10,000 in Fund A, the one with the lower fee, would grow to about $76,000. Not bad. But your investment in Fund B, with that seemingly tiny extra 1% fee, it would only grow to about $57,000. That's a $19,000 difference. That 1% fee cost you a brand new car. It devoured nearly a quarter of your potential profits. All for what? Often for nothing. A higher fee does not guarantee better performance. In fact, studies have consistently shown that lower-cost funds tend to outperform their more expensive peers over the long run. So when you're looking at that prospectus, hunt for the expense ratio. It's usually in a table near the front. If it's over 1%, you should have a very, very good reason for investing. Is the fund manager a legendary genius with an unbelievable track record? Maybe. But for most funds, a high expense ratio is just a red flag. A warning sign that the fund is designed to make its managers rich, not you. Look for other sneaky fees too, like sales loads, which are commissions you pay to buy or sell the fund, or 12b1 fees, which are extra marketing fees. The lower the total cost, the more of your own money you get to keep. It's that simple. So now you have the core of the treasure map decoded. You know the fund's destination, its objective. You know the planned route, its strategy. You know the dragons and sea monsters to watch out for, the risks. And most importantly, you know the price of the ticket, the expense ratio. You're no longer just a passive passenger. You're an informed navigator. But there's one more critical piece of the puzzle. The map tells you the plan, but it doesn't tell you about the person holding the wheel. How good is the driver? What's their track record? And how do you find out who's actually in charge of your money? That's where we go from reading the manual to running a background check on the manager themselves. So you've got the fund's prospectus in hand. It's like the owner's manual for a complex machine. It tells you what all the buttons do, what it's designed for, and what to expect under normal operating conditions. But the manual doesn't tell you about the person holding the wheel. How good is the driver? What's their track record? And how do you find out who's actually in charge of your money? That's where we go from reading the manual to running a background check on the manager themselves. Think of a mutual fund manager as the head coach and general manager of a professional sports team, all rolled into one. They decide which players, in this case stocks like ExxonMobil, Chevron, or a smaller solar panel company, get to be on the team. They decide when to trade them, when to bench them, and how to position the entire portfolio to win against the competition, which is the market itself. Your investment success is directly tied to their skill, their strategy, and their discipline. So, you absolutely need to know who this person is. Your first step is simple. Find their name. It's usually listed prominently in the fund's summary prospectus and on its website under a section like Fund Management or Portfolio Managers. Don't be surprised if you see a team of names. We'll get to that later. For now, let's assume there's a lead manager. You have a name. Now the real investigation begins. The first and most critical piece of data you need is their tenure. Specifically, how long have they been managing this exact fund? This is a deceptively important question. You might see a fund with a spectacular 10-year track record, showing incredible returns. But if the current manager just took over 6 months ago, that 10-year record is almost completely irrelevant to you. The old coach won those championships. You're betting on the new one. You're investing in the future, not the past, and the manager is the person who will be making the future decisions. Look for a manager who has been at the helm for at least 5, preferably 10 years or more. This shows they've navigated the fund through different market cycles, not just a single roaring bull market where everything goes up. Once you've established their tenure, you can start to analyze their performance. But here's a pro tip. Never look at a fund's performance in a vacuum. A fund that returned 15% last year might sound amazing. But what if the energy sector as a whole, as measured by its benchmark index like the S&P Energy Select Sector Index, was up 20%? In that case, your highly paid, expert manager actually underperformed. They didn't just ride the wave. They were dragged along by it, and not even that well. You are paying for a manager to make smart decisions that beat the average, not just match or lag it. Always compare the fund's performance to its specific benchmark index over 1, 3, 5, and 10-year periods. The great managers consistently find ways to outperform their benchmark, even if by a small margin. Over time, that small margin compounds into a massive difference in your wealth. But here's where the real detective work separates the amateurs from the serious investors. Don't just look at the good years. Look at the bad ones. How did the manager perform during a crisis? Pull up a chart of the energy sector and look at the major downturns. Think about the oil price collapse of 2014 to 2016. Think about the initial shock of the pandemic in March 2020. How did this fund fare compared to its peers and its benchmark during those periods of intense fear and volatility? This is the ultimate stress test. Anybody can look like a genius when oil prices are soaring. But what did they do when the ship was taking on water? Did they panic and sell at the bottom? Did they make disciplined strategic moves? Did they protect capital better than their competitors? A manager who can minimize losses during a downturn is often more valuable than one who just captures big gains in an upmarket. This is called downside protection, and it's the hallmark of a truly skilled manager. Next, you need to understand their philosophy. What is their game plan? Are they a value investor, like a bargain hunter, searching for solid, cash-producing energy companies that the market has unfairly beaten down? Or are they a growth investor, willing to pay a premium for companies on the cutting edge of renewable technology or new drilling techniques, betting that their rapid growth will justify the high price? Maybe they're a quant, using complex computer models to make buy and sell decisions. There's no single right answer, but the manager's stated philosophy must match the fund's actions. If a manager says they're a conservative value investor, but their portfolio is full of speculative, high-risk solar startups, that's a major red flag. It shows a lack of discipline. You can find their investment philosophy detailed in the prospectus, and often in shareholder reports or interviews. You need to know if their style of play aligns with your own risk tolerance and financial goals. Now for one of the biggest insider secrets. Finding out if the manager has skin in the game. In other words, does the manager personally invest their own money in the very fund they are managing for you? Think about it. If a chef refuses to eat at their own restaurant, would you want to book a table there? Of course not. When a fund manager invests a significant amount of their own net worth alongside the shareholders, it creates a powerful alignment of interests. Their financial success becomes directly tied to your financial success. They feel the pain of losses and the joy of gains right along with you. This isn't just symbolic. It's a profound signal of their confidence in their own strategy and stock-picking ability. So how do you find this information? It's not usually on the main marketing page. You have to dig a little deeper into a document called the Statement of Additional Information, or SAI. It's like the detailed appendix to the main prospectus. Every fund is required by the SEC to disclose how much of the manager's own money is invested in the fund, broken down into ranges. Look for a manager who has over $1 million of their own money invested. It's a powerful vote of confidence that you simply can't get from a performance chart. Finally, consider the structure of the management team. Is it a single-star manager or a committee? A fund run by a legendary single manager can be a huge asset. They can be nimble, decisive, and act on their convictions. The downside is what's known as key person risk. What happens if that star manager retires, gets sick, or leaves to start their own hedge fund? The fund's entire strategy and performance could change overnight. A team-managed approach, on the other hand, provides more stability and continuity. A diverse team can bring different perspectives and areas of expertise, whether it's in oil and gas exploration, utility regulation, or solar technology. The risk is that a committee can sometimes lead to groupthink or a more watered-down, less decisive strategy. Neither approach is inherently superior, but you need to be aware of the structure and its potential implications. Scrutinizing the fund manager is not about trying to find a flawless superhero. It's about understanding who you're hiring to manage your hard-earned money. You're looking for experience, a consistent and disciplined process, a track record of outperformance, especially in tough times, and a genuine alignment with your own financial interests. It takes a little more effort than just looking at a star rating, but this due diligence is what transforms hopeful speculation into a sound, long-term investment strategy. You've now vetted the vehicle and you've run a background check on the driver. You've found a fund with a clear strategy that you understand, run by an experienced manager with a solid track record and their own skin in the game. It feels like you're ready to go. But there's one last critical piece of the puzzle we have to examine before you ever invest a single dollar. It's the hidden cost, the number that quietly, relentlessly eats away at your returns year after year. You've found the perfect car, you've vetted the driver, but you haven't looked at the sticker price yet. And in the world of mutual funds, the real cost isn't always printed in big, bold numbers. You have to know where to look. The most visible cost is something called the expense ratio. It's a percentage and it seems small, often less than 1%. But I want you to stop thinking of it as a percentage. Think of it as a parasite, a small silent creature that attaches itself to your investment and feeds on it every single day, year after year, whether your fund goes up or down. This little parasite is made up of a few different things. First, the management fee. This is what you pay the fund manager, our expert driver, to pick the stocks. Then you have administrative costs. These are the boring but necessary expenses: record keeping, customer service, office space. And then there's a sneaky one, often called a 12b-1 fee. This is the fee the fund charges you to pay for its own marketing and advertising. That's right. You are paying for the commercials and glossy brochures that convinced you to invest in the first place. Now, you might see an expense ratio of say 0.75% and think, that's less than a penny on the dollar. No big deal. This is the single most expensive mistake an investor can make. Let's run the numbers. Let's say you invest $100,000 into two different energy funds that have identical performance before fees. Fund A has an expense ratio of 0.5%. Fund B has an expense ratio of 1.5%. Just a 1% difference. Both funds grow at an average of 8% per year for 30 years. After 30 years, your investment in Fund A, the low-cost fund, would be worth over $875,000. Not bad. But your investment in Fund B, the one with that tiny extra 1% fee, it would be worth about $685,000. That's a difference of $190,000. That 1% fee didn't just cost you 1% a year. Because of the brutal math of compound growth, it cost you a house. It cost you a comfortable retirement. It's a slow, invisible bleed that drains the lifeblood from your portfolio. The expense ratio isn't just a cost. It's a direct tax on your future wealth. But wait, there's more. The expense ratio is just the annual cost of owning the car. What about the cost of buying it? This is where we get into something called sales loads. A load is basically a commission paid to the broker or financial advisor who sold you the fund. It's their payday, and they come in a few different flavors, usually designated by different classes of fund shares: Class A, Class B, and Class C. Class A shares have what's called a front-end load. This means you pay the commission right when you buy the fund. If you invest $10,000 with a 5% front-end load, $500 is immediately taken off the top and goes to the broker. Only $9,500 actually gets invested. It's a painful upfront hit. Then you have Class B shares. These often come with a back-end load, also known as a contingent deferred sales charge. This sounds complicated, but the idea is simple. They advertise it as no upfront commission, which sounds great. But there's a catch. If you sell your shares within a certain period, usually 5 to 7 years, you get hit with a fee on the way out. This fee typically decreases each year you hold the fund, eventually going to zero. The fund company does this to lock you in. They want you to stay so their parasite, the expense ratio, can keep feeding for years. And to make matters worse, Class B shares almost always have higher annual expense ratios than Class A shares to compensate the broker over time. Finally, there are Class C shares. These are often called level load shares. They typically have no front-end load and a small back-end load that might only last for 1 year. Sounds like the best of both worlds, right? Wrong. Class C shares are a trap for the long-term investor. They carry the highest annual expense ratios of all. That 12B1 marketing fee we talked about? It's usually maxed out in Class C shares. While you avoid the big one-time hit, you are sentencing yourself to a lifetime of being bled dry by higher annual fees. For a short-term investment, maybe a year or two, they might make sense. But for anyone investing for retirement, Class C shares can be financial poison. The key takeaway is this: you want to look for no-load funds. These funds don't charge any sales commission at all. You can buy them directly, and 100% of your money goes to work for you from day one. In today's market, with so many amazing low-cost options, there is very little reason for the average investor to ever pay a sales load. So we've covered the annual cost and the cost to buy. But there's one more cost. This is the one that's truly hidden. It's not in the expense ratio, and it's not a sales load. It's a ghost in the machine, an invisible friction that can grind down your returns without you ever seeing it on a statement. It's generated by something called the turnover ratio. The turnover ratio tells you how often your fund manager is trading the stocks inside the portfolio. A turnover ratio of 100% means that, on average, the manager has replaced every single stock in the fund within the past year. A ratio of 20% means they've only replaced a fifth of the holdings. Now, why does this matter? Because every single time the manager buys or sells a stock, the fund incurs transaction costs. Brokerage commissions, bid-ask spreads, it all adds up. And who pays for that? You do. These costs are not included in the expense ratio. They are deducted directly from the fund's assets, quietly reducing your overall return. Think about it. If you have a fund manager who acts like a hyperactive day trader, constantly jumping in and out of energy stocks, chasing headlines, he's racking up enormous trading costs. He might look busy, he might even sound smart, but he's churning your account. It's like having a driver who insists on taking the toll road everywhere, paying with your money, even when the freeway is free and clear. A high turnover ratio can be a massive red flag. It not only creates a drag on performance from the costs, but it can also be a sign of a lack of a coherent, long-term strategy. The best investors, the Warren Buffetts of the world, don't trade constantly. They buy great companies and hold them. A fund with the low turnover ratio, say under 30%, often indicates a manager with a patient, disciplined approach. They're not just reacting to noise, they're investing with conviction. So when you're comparing two energy funds, and they have similar expense ratios, check the turnover ratio. The fund with the lower turnover is often the more efficient, cost-effective, and strategically sound choice for the long haul. Ignoring this number is like ignoring the fuel efficiency of your car. You might have saved on the sticker price, but you'll get eaten alive at the pump. These three costs, the expense ratio, the sales loads, and the hidden drag from turnover, are the true price you pay. Knowing how to spot them, how to read them, and how to avoid them is the difference between cruising toward your financial goals and running out of gas halfway there. So let's talk about the map. Because every journey needs one. Especially a journey where your financial future is the destination. That prospectus you get, that thick, intimidating booklet filled with dense legal text that most people immediately use as a coaster, that's not just a formality. It is the single most important document you will ever receive about a mutual fund. It is the blueprint, the owner's manual, and the treasure map all rolled into one. Ignoring it is like buying a car without ever looking under the hood, checking the title, or even taking it for a test drive. You're just trusting the slick salesman in the shiny suit, and we just learned how expensive that trust can be. The first section you need to turn to is the investment objective and strategy. This sounds boring, but I want you to reframe it. This is the fund's mission statement. It's the fund telling you in its own words, this is who I am, this is what I do, and this is how I plan to do it. Is its goal to generate income by investing in high-dividend oil majors like Exxon and Chevron? Or is its objective aggressive growth, chasing 10-baggers by investing in small, speculative exploration companies drilling in unproven fields? Is it a pure-play fossil fuel fund? Or does it have a mandate to mix in solar, wind, and other alternative energy sources? The difference isn't just academic. It's the difference between a fund that might chug along steadily and one that could either rocket to the moon or crash and burn spectacularly. I knew a guy years ago who invested a chunk of his retirement savings into what he thought was a diversified energy fund. He just saw the word energy and assumed it was a safe bet on the big household names. He never read the strategy section. 6 months later, his investment was down 40%. Why? Because the fund's actual strategy was to concentrate its holdings in highly leveraged, small-cap shale oil producers. When oil prices took a sudden dip, those companies got wiped out, and so did his investment. He was driving a Formula One car when he thought he'd bought a Toyota Camry. The prospectus would have told him that on page 1. Right after you understand the mission, you need to read the principal risk section. This is the part everyone skips because it's scary. It's a long list of all the terrible things that could happen to your money. But thinking you can avoid risk by not reading about it is like a pilot thinking they can avoid a storm by not looking at the weather radar. The risks are out there whether you acknowledge them or not. The professional investor, the smart investor, reads this section first. They want to know every possible way they could lose. For an energy fund, this list is critical. You'll see things like commodity price risk. That's the big one. It means the fund's value is tied to the wild, unpredictable swings of oil and natural gas prices. You'll see geopolitical risk. That means a conflict halfway around the world could disrupt supply chains and send your fund's value plummeting overnight. You'll see regulatory risk. A new environmental law, a change in drilling permits, or the end of a tax credit could completely change the game for the companies in the portfolio. And increasingly, you'll see stranded asset risk. The danger that fossil fuel reserves owned by these companies could become worthless as the world transitions to cleaner energy. Reading this section isn't about scaring yourself out of investing. It's about understanding the battlefield before you step onto it. It's about knowing what you're signing up for with eyes wide open. Next, you flip to the performance history. You'll see a bar chart and a table showing the fund's returns over the last year, 5 years, and 10 years. And right below it, you'll see the most famous sentence in finance. Past performance is no guarantee of future results. Everyone knows the phrase, but almost no one understands what it really means. It means you can't just look at a fund that's gone up 50% in the last year and assume it will do it again. That's like driving by looking only in the rearview mirror. What you need to do is look at that performance with context. How did this fund perform during the last major energy downturn like in 2014 or 2020? Did it get completely crushed? Or did the fund manager play defense and preserve capital better than its peers? How did it do during the subsequent recovery? Did it capture the upside? Or was it too cautious and missed the rally? You're not looking for a fund that only goes up. That doesn't exist. You're looking for a fund whose character, whose behavior in both good times and bad, aligns with your own tolerance for risk. You're trying to understand how this fund behaves under pressure. Now, while the prospectus is your map, there's another document that's like the secret decoder ring. It's called the Statement of Additional Information, or the SAI. The fund company has to give it to you if you ask, but they don't typically mail it out. It's the prospectus's much nerdier, more detailed older brother. And this is where you find the really juicy details. The SAI tells you things the prospectus only hints at. It provides specific details about the portfolio manager's compensation. Are they paid a bonus for short-term performance, which might encourage risky bets? Or is their compensation tied to long-term results over 3, 5, or even 10 years? That's a huge tell about the fund's culture. The SAI also gives you the nitty-gritty on how the fund uses complex derivatives like options or futures, if at all. It's a bit like the director's commentary on a DVD. It gives you the behind-the-scenes story that adds a whole new layer of understanding. You don't have to read all 100 pages, but knowing what to look for can give you an edge that 99% of other investors simply don't have. Finally, after you've dissected the documents, you have to look beyond the paper at the human element. A mutual fund isn't an algorithm. It's a vehicle being driven by a person, the portfolio manager. Who is this person? What's their background? How long have they been managing this specific fund? Have they successfully navigated a full energy market cycle, the boom, the bust, and the recovery? Or are they a hotshot manager who's only ever seen a bull market where everything goes up? There's a world of difference between a manager who has the scars and the wisdom from the 2008 financial crisis and the 2014 oil collapse, and one who started in 2021 and thinks they can do no wrong. You can usually find the manager's name and tenure in the prospectus or the fund's annual report. A quick search will often bring up interviews, articles, and their professional history. You're hiring this person to manage your money. You owe it to yourself to do a background check. You're not just investing in a portfolio of stocks. You're investing in the experience, the philosophy, and the discipline of the person at the helm. So before you even think about hitting the buy button, you need to become a detective. You need to have the prospectus in one hand and the SAI in the other. You need to be able to answer without hesitation. What is this fund's precise mission? What are the primary dangers that could sink it? How has it behaved when things got ugly in the past? What are the total all-in costs I'm paying every single year? And who is the captain steering this ship? Answering these questions is the work. It's the due diligence that separates gambling from investing. It's what transforms you from a passive passenger, hoping you end up in the right place, to an informed pilot, in full control of your journey. Once you've found a fund that passes this rigorous inspection, a fund with a clear strategy, a seasoned manager, reasonable fees, and a risk profile you can stomach, then and only then can you start to ask the next, even more important question. Is this great fund actually the right fund for me? Because picking a world-class vehicle is one thing. Knowing how it fits into your garage, your lifestyle, and your ultimate destination, that's a whole different challenge. A brilliant, high-octane energy fund might be the worst possible investment for a retiree, while a slow and steady dividend payer might be a terrible fit for a young, aggressive investor. Understanding how to match the fund to the investor, and how to build a resilient portfolio that won't collapse at the first sign of trouble, that's where the real art of investing begins. So let's talk about building that resilient portfolio. The single biggest mistake an investor can make with a sector fund, whether it's energy, tech, or healthcare, is making it the foundation of their house. A sector fund is not the foundation. It's the high-tech home security system, the solar panels on the roof, or the custom-built home theater in the basement. It's an enhancement, an addition, a strategic bet, not the concrete slab everything else rests on. This is often called the core and satellite approach to portfolio construction. Your core is the vast majority of your portfolio, maybe 80 to 95%. This is your bedrock. It's typically made up of broad, highly diversified, low-cost index funds. Think of an S&P 500 fund that holds the 500 largest US companies, or a total stock market fund that holds thousands of them. This core is designed to capture the overall growth of the entire economy. It's stable, it's reliable, and it's boring, in the best possible way. Then you have your satellites. These are smaller, more concentrated positions that orbit your core. This is where your energy mutual fund lives. A satellite position is a targeted bet on a specific area of the market that you believe will outperform the broader market over time. Because it's a concentrated bet, it carries more risk, but it also offers the potential for higher returns. Your energy fund is a satellite. So is that biotech fund you've been eyeing, or that fund focused on emerging markets? The beauty of this structure is that it gives you the best of both worlds. The core provides stability and broad market growth, ensuring that one bad bet won't sink your entire portfolio. The satellites give you the opportunity to juice your returns and express a specific investment thesis. Like, I believe the long-term demand for energy is being underestimated. So the critical question becomes, how big should that satellite be? How much of your portfolio should you allocate to an energy mutual fund? There is no single right answer, but we can work with some powerful guidelines. It all comes down to your personal risk tolerance, your age, and your investment horizon. Let's imagine a conservative investor, perhaps someone nearing retirement. They want to protect their capital but also keep up with inflation and generate some income. For them, a satellite position in energy might be just 1 to 3% of their total portfolio. It's a tiny slice. If the energy sector doubles, it gives their portfolio a nice little nudge upward. If the sector gets cut in half, it's a minor annoyance, a small dent that the other 97% of their portfolio can easily absorb. It's a diversification play, not a get-rich-quick scheme. Now consider a moderate investor, maybe in their 40s with a solid career. They have a longer time horizon and can stomach a bit more volatility. Their allocation to an energy fund might be in the 5 to 8% range. This is a meaningful position. A strong run in energy will have a noticeable positive impact on their overall net worth. A downturn will sting, but it won't be catastrophic. Their core holdings are still doing the heavy lifting, but this satellite has enough weight to make a real difference. Finally, let's look at the young, aggressive investor. They're in their 20s or early 30s, with decades to invest and recover from any downturns. They might allocate 10, 12, or even 15% to an energy fund. For them, this is a high-conviction bet on the future. They understand that this slice of their portfolio could see wild swings, but they're willing to accept that risk for the potential of massive long-term growth. Even for this investor, putting 50 or 100% into a single sector is widely considered reckless gambling, not investing. The danger of overconcentration cannot be overstated. Let's paint a picture. It's mid-2014. Oil is trading at over $100 a barrel. The US shale boom is in full swing, and energy stocks are the darlings of Wall Street. An investor, let's call him Mike, sees this and thinks, this is it. This is the future. He takes his entire life savings and plows it into a handful of aggressive energy mutual funds. For a few weeks, he feels like a genius. Then the floor falls out. A global supply glut and a price war send oil prices into a freefall. Over the next year and a half, oil plunges from over $100 to below $30. Mike's portfolio, which was 100% concentrated in energy, is utterly annihilated. He loses over 70% of his capital. It's a life-altering disaster. Now, consider another investor, Sarah. In mid-2014, she also believed in the long-term story of energy, but she followed the core and satellite approach. She allocated 7% of her portfolio to an energy mutual fund. The other 93% was in a boring, diversified S&P 500 index fund. When the crash happened, her 7% energy slice got hammered just like Mike's. It hurt. But while that part of her portfolio was down 70%, the other 93% of her portfolio, the core, was holding up just fine, tracking the broader market. Her total portfolio took a hit, but it was a flesh wound, not a fatal blow. She was still in the game. And this is where the second secret weapon of the savvy investor comes in: rebalancing. Rebalancing is the simple, disciplined act of periodically resetting your portfolio back to its original target allocations. It is one of the most powerful and psychologically difficult things you can do. Let's go back to Sarah. Her target was 7% in energy. After the big run-up in early 2014, maybe her energy fund had grown to become 10% of her portfolio. When she rebalanced, say at the end of the year, she would have sold off that extra 3% of her energy fund, locking in profits when it was flying high, and put that money back into her core S&P 500 fund. She was automatically, systematically selling high. Then the crash came. A year later, her energy holdings, which started at 7%, were now maybe only 2% of her total portfolio because they had lost so much value. When she rebalanced again, the discipline required her to do the opposite. She had to sell some of her S&P 500 fund, which had done relatively well, and use that money to buy more of her beaten-down energy fund to get it back up to her 7% target. She was automatically, systematically buying low. This is the opposite of what our human emotions tell us to do. Our brains scream at us to sell what's crashing and buy more of what's soaring. Rebalancing forces you to be a contrarian. It imposes a mechanical discipline that prevents you from making fear-based or greed-based decisions. It's the portfolio's automatic immune system. For those just starting out, the idea of investing a lump sum into a volatile sector can be terrifying. This is where another strategy, dollar-cost averaging, becomes your best friend. Instead of trying to time the market and invest $12,000 all at once, you simply invest $1,000 every month on the same day, no matter what the market is doing. When energy prices are high and the fund's shares are expensive, your $1,000 buys fewer shares. When energy prices crash and the shares are cheap, your same $1,000 buys way more shares. Over time, this smooths out your purchase price and can dramatically lower your average cost per share, reducing the risk of bad timing. It turns volatility, the enemy of the lump sum investor, into an advantage for the systematic investor. When you combine these ideas, the core and satellite framework, a sensible allocation, disciplined rebalancing, and dollar-cost averaging, you create a powerful, robust system. This isn't just a collection of tips. It's a comprehensive strategy for integrating a volatile, but potentially rewarding asset class like energy into your long-term financial plan without blowing yourself up. It's how you move from simply buying a fund to intelligently building a portfolio. This strategic framework answers the "what if I'm wrong?" question. What if you invest right before a crash? Your small allocation protects you, and dollar-cost averaging allows you to buy more at lower prices. What if you get scared and want to sell at the bottom? Your rebalancing discipline forces you to buy instead. The system is designed to protect you from the market's volatility, and more importantly, from your own worst emotional instincts. So we've built the framework, we understand the strategy for managing risk and building a position over time. But all of this rests on the assumption that the energy sector itself has a future. And that future is more complex and uncertain than ever before. The entire global energy landscape is shifting beneath our feet. We're in the middle of a massive transition, with renewables, geopolitical tensions, and incredible technological breakthroughs all rewriting the rules. Navigating this future requires looking beyond the traditional oil and gas playbook. And that's exactly where we're going next. So what does this new playbook look like? It's not about abandoning the old one entirely, but about adding new chapters, new strategies, and a whole new set of players. The future of energy investing is a story of specialization and technological disruption. Forget the monolithic idea of an energy fund. Today, we're talking about a spectrum of highly specialized vehicles designed to capture very specific slices of this multi-trillion-dollar transition. Let's start with the most obvious category: clean and renewable energy funds. These are the funds you hear about most often. Their mission is straightforward: invest in companies that are generating power from sources like solar, wind, geothermal, and hydropower. Think of companies that own and operate massive solar farms in the Nevada desert or sprawling wind turbine arrays off the coast of Massachusetts. The investment thesis here is powerful and easy to grasp. You're betting on a future powered by clean electricity, driven by falling technology costs, massive government incentives like the Inflation Reduction Act, and growing corporate and consumer demand for sustainability. These funds offer pure-play exposure to the green revolution, but they also come with their own unique set of risks. Their performance can be heavily tied to government policy, which can change with election cycles. They are also sensitive to interest rates, as building large-scale renewable projects requires significant upfront capital and debt. But here's where it gets more nuanced and frankly more interesting. A second and perhaps more sophisticated category is the Energy Transition Fund. This is a crucial distinction. These funds don't just invest in the new kids on the block, they also invest in the old guard, the traditional oil and gas giants that are actively and aggressively working to reinvent themselves. They operate on the pragmatic principle that the global energy transition won't happen overnight. It needs the scale, the engineering expertise, and the deep pockets of the existing energy titans. So, a fund like this might hold a leading solar panel manufacturer right alongside a supermajor like Shell or BP, but specifically because those companies are pouring billions into natural gas, hydrogen infrastructure, carbon capture technology, and electric vehicle charging networks. The bet here isn't just on renewables. It's a bet on the transition itself. It's a more diversified, and some would argue more realistic, way to invest in the future of energy, acknowledging that for decades to come, we will need a mix of old and new energy sources. Then we have what I call the picks and shovels play: energy technology and infrastructure funds. These funds take one step back from the power producers and instead invest in the companies that make the entire transition possible. They aren't buying the gold mine. They're selling the picks, the shovels, and the blue jeans to all the miners. In the energy world, this means investing in the company that manufactures the most efficient wind turbine blades, the one that develops the next-generation battery storage systems, or the software company that builds the smart grid technology to manage it all. This can be an incredibly powerful strategy. It insulates you, to a degree, from the commodity-like business of just selling electricity. Instead, you're investing in the intellectual property, the innovation, and the critical components that everyone in the energy sector will need, regardless of who ultimately wins the power generation race. This category also includes companies focused on upgrading our nation's aging electrical grid, a monumental task that will require hundreds of billions of dollars in investment over the coming years. And finally, we have the contrarian and highly specialized plays like nuclear and uranium funds. For years, nuclear power was a forgotten corner of the energy market. But with the global push for carbon-free, reliable 24/7 baseload power, nuclear is having a major renaissance. These funds invest in uranium miners, the companies that enrich and process nuclear fuel, and even the firms designing the next generation of small modular reactors. This is a high-risk, high-reward area. It's a bet that the world will overcome its political and social hesitancy towards nuclear power out of sheer necessity for clean, dependable energy. The performance of these funds is tied not just to the price of uranium, but to complex geopolitics and the slow, deliberate pace of regulatory approval for new reactor designs. So you have this incredible new menu of options. But with new options come new risks. The policy risk is immense. A single piece of legislation can create or destroy fortunes in the renewable sector. Technological risk is another giant. A breakthrough in battery chemistry could render a dominant company's technology obsolete overnight. And then there's valuation risk. Because the future of clean energy is such a compelling story, these stocks can become incredibly popular and trade at eye-watering valuations that get way ahead of their actual earnings. You have to be careful not to overpay for a good story. This means your analytical toolkit has to evolve. When you analyze one of these new era energy funds, you can't just pull up a chart of West Texas Intermediate crude oil. You need to ask different questions. First, what is the fund's specific thesis? Read the prospectus. Is it a pure-play solar fund? Is it betting on grid modernization? Is it an all-of-the-above energy transition fund? You need to know exactly what story you are buying into. Second, dig into the top holdings. Don't just trust the name on the tin. A clean energy ETF might sound great, but you could look inside and find that its top holding is a legacy utility company that still gets 50% of its power from natural gas. Is that what you wanted? Or is it filled with highly speculative, pre-profitability tech startups? Understanding the composition of the fund is non-negotiable. Third, look at the expense ratios. Specialization often comes at a price. These thematic funds frequently have higher management fees than a simple, broad-market S&P 500 fund. You have to decide if the targeted exposure and the potential for higher growth is worth that extra cost. So how do you put this all together? How do you combine the old world of energy with the new? Many sophisticated investors use what's called a core and satellite approach. Your core holding might be a large, diversified, traditional energy mutual fund, one that owns the big, stable, dividend-paying integrated oil companies. This provides a foundation of income and exposure to the energy sources that power the world today. Then you add your satellites. These are smaller, more targeted positions in the higher growth, more specialized funds we just discussed. Maybe you add a satellite position in a clean energy technology fund to capture the innovation in battery storage. Perhaps another small satellite in a nuclear energy fund as a more speculative long-term bet. This approach allows you to maintain a stable footing in the present while strategically placing bets on different potential futures. It acknowledges the critical reality of this moment. It is not an either/or game. The world will need oil and gas for decades to come, even as the renewable revolution accelerates. The most astute energy investors of the next generation will be the ones who understand the delicate and complex interplay between the two. We've come a long way in this journey. We started with a simple concept of a barrel of oil, and we've ended here at the crossroads of technological disruption, geopolitical strategy, and the single greatest economic transition in human history. We've seen how energy mutual funds work, from their structure and costs to the dividends they pay, and the immense global forces that shape their performance. The goal was never to give you a hot stock tip or tell you which fund to buy. It was to give you a framework, a mental model for understanding one of the most critical and complex sectors of the global economy. You now have the vocabulary and the concepts to analyze these investments on your own terms, to look past the headlines and understand the fundamental drivers at play. Investing in energy is no longer just about geology and drilling rights. It's about material science, software, public policy, and global logistics. It's about the price of lithium as much as the price of oil. The energy transition will create enormous new industries and crown new corporate kings, while challenging the dominance of the old. Understanding how to invest in this change isn't just about building a better portfolio. It's about understanding the very blueprint of the 21st century world being built around us, right now.